What an interesting times to meet and discuss, right?
Yeah.
It's a great theme to talk about, I think, resilience and sustainability in the wake of what happened with FTX and the industry as a whole that got shook by the recent events in the midst of an already pretty harsh bear market. Why don't we try to spin this discussion around creating a cheat sheet for retail and institutions alike to be able to better navigate the coming months, which are, I think, very challenging, and I'd love to pick your brain on what you think the macro looks like. What does the both crypto and traditional finance macro outlook is like at the moment for you?
Yeah, so I think we have to look at what controls price, right? It's three main mechanisms. You have liquidity, right? You have network adoption, and you have macro factors, which obviously Guy is bringing up. When we look at last year, we had network adoption had greatly exceeded, right, liquidity, which caused the boost in price, right? This year it's been the macro factors having a massive negative impact on the space across TradeFi and the digital asset space as well. If we look at kind of recent history, in October we had roughly 264,000 jobs in the US, roughly, 284 back then, about 264 in November, and unemployment right now is roughly 3.7, right, in the US at least. I don't think that the Fed will start, flipping that switch until we see maybe 4.55%. I don't see that happening next year. I think that we have, as you and I have discussed, Guy, another 18 months at minimum, of this trend and this process, right, that the Fed is using to control inflation. I think a lot of investors at this stage actually think that inflation is being controlled a bit better than expected. I would disagree. I think that there's still a lot more blood in the water. And I think if we look at the macro factors in the digital asset landscape, right, we look at what happened with Luna, we look at these weird and hybrid forms of stable coins that have proven many times to not be that stable. If we look at Voyager, we look at BlockFi, we look at FTX, I think the discussion that we'll have today in retail and institution actually protecting those assets is more timely than ever. So I think that there's more blood in the water, and that's not a bad thing. I think in hindsight, this is part of the growing process, right, and growing pains that lead towards, $10 trillion market cap. We will get there. We will greatly exceed that number years from now. But we need regulation. I'm a, ex-attorney, securities lawyer, so it's highly important, right? We need it. It's coming soon. And I think that some aspects of insider information, which is utilized in this space, right, will become limited.
Makes a lot of sense. I think the current geopolitical unstable world between what we have in North America, the current war happening in Ukraine and China, creates a very interesting triangle, right, between a world that feels like it's deglobalizing, and I totally feel you when you say that you don't think inflation's going away anytime soon. I actually think that we're transitioning into maybe a decade of instability and higher inflation. I don't really feel confident in saying that the Fed is going to do a great job at reducing it to 2%, because the low inflation world really has a bunch of pillars, which are supply chain that is smooth and fast from China, that can also have really cheap jobs and smooth execution. You have natural gas coming from Russia, that's of course not happening, and you have the current situation with the monetary tightening in the US from the Fed. I think, as you were correctly saying, the worst might have yet to come, because we're still in a hiking environment with the Federal Reserve, and unemployment's still remarkably low in terms of what we've seen in the past 30 to 40 years. What we usually see is when the Fed is hiking and goes into pivoting and then pauses and starts cutting rates, we still see the unemployment go up, and that's really when the recession starts to kick in, right? We're still not, even though we had 2 negative quarters of GDP growth in the US, we're still not officially potentially in a recession. Unemployment is still good, and I think the moment we still see unemployment really start to kick up is when we should start to really be worried, right?
Yeah, I agree completely. I think, we don't want to make this discussion doom and gloom. I think we should always be realistic. We should be practical. And I think that the overarching theme of the digital asset space, it remains unchanged, right? Technology is booming. The building aspect of this sector is just explosive right now. There's a lot of capital that's pensive. It's waiting on the side. I mean, we know that. We're in a massive capital raise right now, and our discussions have required more meetings to secure that capital, and that's fine. A lot more explaining, a lot more converting from our standard black box hedge fund structure of New York to more of a gray box aspect, right? And educating our investors a lot more. But the building hasn't slowed down at all. The overarching theme of why all of us are in this room remains unchanged. This sector right now, even if we look at Asia, roughly 50% of Asia is unbanked. Right? Yet Asia has one of the highest rates of mobile application utility. That's a massive opportunity. It's why at one point Thailand was the largest consumer or contributor towards the DeFi ecosystem last year. So there's a lot of opportunity. I think it's a matter of stepping back, remaining calm, protecting your assets, maybe going into more defense rather than offense, and preparing for that next bull run, which I don't think is happening next year. Maybe towards the tail end of 2024, we'll see some, trend reversal.
It's great to still remain optimistic because, as you were just rightly saying, the number of developers in the space is ever growing, right? The number of investors that are pulling in capital is still, they're more worried now, but they're still really interested into pulling capital. And you see giant players like BlackRock around the 20,000 level for Bitcoin. You're really being interested in the space and developing. Fidelity recently, a few months ago. So let's talk about how to practice a good defense, because the interest is here, and we want these players to really have confidence and have trust. What is your best practices as an institution, both on the venture side and also on the trading side, to create as much of an airtight environment as possible when it comes to investing?
Yeah, great question. So we obviously have a quant trading division, we have a venture division. Some aspects of what you mentioned overlap, some are completely separate. So I would say that the first thing is you need to protect your assets, right? And FTX has proven that. FTX and Alameda primarily would compel, let's say, compel their portfolio projects to leave assets on exchange. Well, now in hindsight, we know why, right? They were actively using that capital in a way that they shouldn't have. So I think when we talk about capital preservation and we talk about asset protection, where are you actually keeping your assets? I cannot divulge exactly where we're keeping them unless you're an LP. So if you want to give me your money, I'll give you the details. But there are a lot of custody solutions out there. Leaving money on an exchange has always been a terrible idea. From Mt. Gox up until a few weeks ago, it remains unchanged. Using a ledger, a Trezor, if you're a retail investor, I think just goes without saying, one of the best investments you can make. You can also end up buying what's called a YubiKey. A YubiKey is another layer of authenticating a withdrawal or maybe API creation, specifically through the big exchanges like Binance. So one of the best investments you can make is a ledger and a YubiKey, and you're already in a good place as a retail investor. As an institution, there's a lot of custody solutions that exist right now. Fireblocks is a custody solution, not a custody provider. A lot of people are utilizing that. They use SOC 2 technology, very difficult to hack. You'd have to hack Microsoft, Intel, and have a gun to the head of whoever controls the keys, which in theory, I guess, could happen. Anchorage, right? There's a lot of options out there on an institutional level. And then the other side is the counterparty risk, right? How do you actually determine, is this a safe exchange that I should trade through? I think that's something that's still being clarified as we're sitting here right now. I don't think many people saw what was happening with FTX. One thing that we pay very close attention to is how are they, number one, do they have a native token? Number two, how are they actually using that native token? Are they leveraging it in any way? If that is an exchange, do they have a in-house investment team? Is that investment team, how are they kind of working within the exchange itself, right? If we look at Alameda and FTX, there was a massive area of overlap that shouldn't have happened. So there's a lot of areas too. We've spoken about insurance before in DeFi. I think insurance still has a lot of room to grow and improve. Sometimes it's hard to, if that protocol or that platform got hacked, to actually recover your assets. Maybe the smart contract doesn't kick in the way that it should. Maybe you have to go through filing a claim. Maybe that claim doesn't process. So I think regulation will greatly enhance all of this.
Do you think regulation is a key factor to building resilience for the space?
100%. It's absolutely necessary. I've never been, one of these rebels in the space that say just leave us alone, complete laissez-faire, just in the true sense, right, of the term, and just let the market figure everything out. We see what happens if, you don't have regulators involved, if you don't, have enough oversight, enough reporting, enough transparency. So I think that's a massive area or pivot point for us getting to 10 trillion market cap.
And regulation has also been lacking, if we can say, in the past few years, when you just see what happened with the SEC deeming that the token was a security. I can't remember who it was. Was it Libroy? Just a few weeks ago, just before FTX, which potentially put in jeopardy a bunch of tokens that could be considered as a security. They did fail to act in due time, and now I think that we're going to start to see them pour in. And I also join you in the fact that I think it's a net positive for the industry, because we don't want to have scandals and fiascos that just happening again. And that's going to be a great part of creating resilience. But also, I think we should, as individuals, make sure that we are resilient without the regulators and the institution ourselves. As you were saying, choosing your custodian is really important. If you're a trader or simply an investor, there is a great way to use leverage to actually build up security and not use it as a degenerate. If you have $100, instead of sending that $100 on your exchange, what you can do is only send $20 and use a 5x leverage to have pretty much $100 position size. This is how you are smart with leverage. This is how you can leverage security to enhance the best practices. There is a lot of things that we can do to make sure that we don't hold all our funds on the exchange, that we make sure that even if these systemic risks happen, we're best insured against these, because as you were saying, you never really know at the end where it might come from, right? I mean, we saw how big FTX was naming stadiums and having people like Tom Brady and people, Steph Curry, vouching for them. It really was a shock for everyone. So we should never be complacent and always enforce the best security practices as traders if we really want to make it. How do you create sustainability as an investor, especially on the venture side? How is the due diligence going to look like for you, for your portfolio companies coming into this next cycle?
Yeah, great question. I think number one is treasury management, right? Number one, where are those assets being kept? Number two, what does that runway look like, right? What does that balance sheet look like? I think that's one of the most important areas. A lot of portfolio projects, right, that for all funds may have been deeply impacted from what happened with FTX. So that's an important thing. And a lot of that, it's kind of strengthened by the founders itself, the founders' resolve and their money management skills. So I think the days of just investing in a project that two guys just met 3 days before at a cafe, one guy owned a grooming business, for pets, and the other guy, owned a bakery, and now they want to launch a massive DeFi protocol, and then being able to raise 100 million, I think those days are done. I think they will return though in the next bull market, which is the funny thing of this business. People seem to have short-term memory issues, right? So I think on the venture front, again, I keep going back to custody. Treasury management is extremely important. I think a lot of our portfolio projects have had to have layoffs. I think they've had to trim the fat in order to, weather the storm. So I think the runway, the trajectory is a massive part. I think also the timing, right? When is this project actually going to have their token generation event if it is a liquid token type of investment? Most of our portfolio projects, we've told them, do not even think about launching this year. You have no pressure from us. And I think a lot of our co-investors on the cap table are in agreement of that. Just build. Learn how to create an edge, kind of anticipate where the market is going, and build with that in mind. And I think this is a long topic we can talk about for a long time, but those are some of the things that come to mind immediately.
Patience has never been more accurate for where we are currently in the cycle, right? And I think you're totally right in telling founders to just take the time to build and not be pressured, especially in these markets. The returns will be held. And talking about returns, once we will finally weather out the storm and the clear skies will show again, on the trading side, on the quant side, how do you see the future? Do you see it as a multi-strategy? How do you evolve leading a quant fund into making sure that it's going to be resilient and sustainable within the next 5-10 years, even if we have high inflation, even if the market is choppy? What is your success formula looking like when it comes to trading?
Yeah, number one is risk management. I mean, we've been meeting with a lot of investors, prospective investors. That's the first slide that we open up at. And Amy, who's sitting right there, our institutional wealth manager, she's brilliant, right? She put together the presentation, but that is what we lead with because that is the number one concern right now. How are you actually going to mitigate risk? How do you combat a massive drawdown or a black swan event? I mean, for us, Luna was a prime example. We coded up an algorithm that would track, TVL outflow and would also track the unpegging of UST from US dollar, and we were unscathed. We actually lost no money during that situation. So that's kind of a DeFi approach, right? On the trading front, I think diversification is a massive component, right? What you mentioned before about using a small amount of capital and using that with leverage, which thereby, reduces your risk greatly because you have less assets on chain, on exchange, is a good approach. I mean, for us, we have roughly 6 to 8 different quant strategies. We are a designated market maker for Binance, Wabi, Gate, KuCoin, all the big exchanges. But we will put Bybit as well. So I know Bybit's here at the event. We love you guys. Great rebate. Thank you. There's a lot of parameters. I think another thing too is a kill switch has become very important to us as a quant firm, right? So when those massive drawdowns happen, and maybe if there was no kill switch, you get caught, in a 10% drawdown, we hit maybe a 1.5% drawdown, right? And as a retail investor, if you have an actively managed trading portfolio, it goes without saying, but a stop loss is your very best friend, right? Dollar cost averaging into positions is also a very useful tool. This is a good time to start accumulating assets that you have a real long-term, strong belief system in, piece by piece. And I'm not saying anything that is revolutionary, right? This is all kind of common sense if you're a retail investor. But I could spend 2 hours talking about risk management on the quant side.
I think it's often overlooked. We often hear people say, oh yeah, everyone should use a stop loss, everyone should do this. When we see the impact of Luna or everything that just happened, and we see really big funds, I mean, 3 Arrows blowing up was just like, how do you over leverage yourself and not have any kill switch in place that you have to completely blow up your treasury and then have a bunch of debts that you can't repay? I think it's also up to us, the remaining actors that have survived this bear market, to enforce and to be voices to really pound risk management into the heads of people, because will grow stronger as an industry. You know, we don't really want to keep having 70, 80% drawdown at every bear market, because it crushes us. It crushes the sentiment. It crushes people that, you know, unfortunately put their life savings into it without much of an understanding of how best do you protect your assets. And having a stop loss, having a long time preference, not over trading. If you're not trading in milliseconds with a high frequency firm, you don't really need to look at your phone all day and make decisions. You know, having things in place such as very simple moving averages. If you only bought and sold Bitcoin today when it crossed its 50 moving averages on the daily, and you bought and you sold when it crosses down on the 50 moving average, you'd be up tremendously today when the whole market is down 70%. I think having a low time preference is crucial for institutions and retail alike, and understanding that the markets don't go up forever, and when they correct really hard. A lot of people have been trying to catch falling knives, and that's usually when the contagion spreads. Risk management is everything.
Yeah, I mean, another big point that you bring up is, I think sometimes traders feel as though they have to be in the market all the time. I think that's a dangerous mindset to have if you're in more of a short time frame, right, type of trader. If you're more long-term, midterm, then that's okay. You still always have a position on. But there have been multiple times throughout this year that we have stepped out of trading. We have completely turned it off. No investors have had an issue with that. You know, anytime that there's a major macro announcement, right? The Fed is meeting, there's CPI print, trading is off, right? We don't really know. We can guess, we can extrapolate, we can, you know, hope for a projected outcome, but you just don't know. So I think more so than any other time, it's perfectly fine to be out of the game, out of the market for a time period, especially if there's a lot of unknown variables. And over trading, emotional trading, it's why quant trading is the least emotional type of trading at all. It removes the human element as much as humanly possible. We were kind of talking about this before. The algorithm doesn't get happy or sad, right? It didn't have a bad day and stub its toe when it got out of bed and decides that it wants to overtrade, right? We dictate what the algo does, and we monitor. We adjust the parameters constantly. Our algos have some elements of machine learning in them too. But at the end of the day, you know, just stepping out of the game, sometimes there's nothing wrong with that.
Very interesting. Back to what you were saying about algorithms. Do you think robots will eventually overtake us because they are emotionless and they just trade better than us? And is artificial intelligence, machine learning, quant strategies, in your opinion, the future of resilience and sustainability? Are we moving towards a world where artificial intelligence is making most of our decisions? How do you see this future of trading, and whether it's low or high frequency? What's your outlook when it comes to this?
Well, I think AI is slowly taking over the world and has been for a long time. I mean, just look at people on their social media now taking these AI images that are all over Instagram. I refuse to do it, but they are pretty cool, right? So, yeah, I think it's penetrating all aspects of our life, whether we're conscious of it or not. And in terms of trading itself, it's kind of a scary thought to think that the robots are going to take over, but maybe they already are. Think about how many times you don't leave the house without your phone. Or if you do, that feeling that you have of you don't have your phone, right? You will go back, 2 hours and drive back home to get that phone. So I think there is this balance we need to strike between dependency on technology and actually peace as just human beings, right? This sounds a little, I don't know, euphoric, right? To have that type of balance. But in terms of trading, we can't do it, at least on the quant level, without the technology that we have. AI does play a big part in that, for sure. I think especially with aspects of machine learning, the system does work better than we do because human error, we're rife with human error. All of us are, right? You may have heard of fat finger syndrome, right? You click the wrong button and before you know it, there were too many zeros, right, on that trade, and now, maybe it worked in your favor, but usually it won't. So I think, will the computers take us over? I think they already have in their capacity to execute, monitor, make changes, but I don't want any computer running my life. That's kind of terrifying.
Thank you. Thank you, guys.
Thank you, Guy. Appreciate it. Thank you.